welcome to the Trade on the Market. I'm Thomas, and in this video I will cover the most important macroeconomics data releases for the week ahead and explain their potential impact on the financial market. And this week the United States is the one under the spotlight regarding last week's bank horror. So sit back, relax, and let's dive into the world of macroeconomics and trading. We are starting the week with a rather easy Monday, which has put every trader back into their old routine. It's a typical, probably lazy start, and the whole day may be uneventful unless there is a panic in the market. Oh, and sorry, there is a panic in the market, so maybe we need to be very careful even on a Monday, and I thought that would be easy. But on Tuesday, there are data releases that may cause low time frame traders and those monitoring economic changes to be glued to their screens. The first is the claimant count change from the United Kingdom, which measures the number of people claiming unemployment-related benefits in the UK. The latest data showed a figure of minus 12.9k, which would indicate the health of the employment sector, given that fewer people are seeking benefits. The question is whether this is because of the strict condition for claiming benefits, or because even the dead are working in the United Kingdom during the middle of a recession. There is also a contradiction here, as with such low levels of benefits, the vast majority of people should be employed and have a lot of money to spend. But they don't. Furthermore, whether the data is false or not, it could have a huge inflationary impact, which could force the Bank of England to implement further drastic interest rate hikes. What we mainly see from the data is that the Bank of England may have wanted to play down the recessionary mood with these numbers earlier, which is now backfiring. Depending on how much the upcoming average earnings and unemployment data will be controversial to the claimant count change, significant effect could be experienced on the BOE monetary policy and therefore on the BXY, the British Pound Currency Index. And we have arrived at the long-awaited moment. Long-awaited from Jeremy Powell's part, as this will have a serious impact on his decision regarding how many basis points the Fed will raise interest rates. Long-awaited from our part as well, as we know that the CPI increase is fundamentally a positive effect on the DXY. And of course, long-awaited by everyone, as further interest rate hikes will continuously slow down and compress the economy, while making livelihoods harder and unemployment rates rise, of course. So on Tuesday afternoon, we are in for a serious menu of economic data from the United States, and you can imagine the chaos it may cause in economic circles. Our first data is the monthly CPI, which shot up with greater force in the previous month than a SpaceX Falcon 9 rocket. It jumped from minus 0.1% to 0.5%, which even made Powell flinch because it gave a slap on his face next to the 25 basis point hike. It is an option that this data will dip slightly, but the options for manipulating the numbers are getting more limited nowadays, so it is possible that the data will finally catch up with the real-life experience. With this data, suddenly reactions are expected in the market, and anything higher than the previous figure is generally positive for the US dollar. If it drops, which I currently see as less likely, it would not have an impact on the US dollar. It should, I know, negatively. However, among other data, the negative impact of this data is already fading away. Second mail on the menu out of the three major is the annual CPI data, which we know that the all-in category, so it includes inflation in energy and food sectors. Last time it came out a 6.4%, which caused a shock among analysts, and at the Fed as well. Actually, this is a decreasing data, and everyone expected it to decrease, right? Yes, except the decrease has slowed down. This is a smaller problem. The bigger problem is that it was higher than expected. Normally, expected data doesn't matter too much, at least. But here it does, because everyone believed that the inflation was decreasing. Even YouTubers believed it, who then made videos about it, which is why you believed it too. Well, good luck for that. I have some bad news. Unfortunately, you got a bad information. The manipulation of the numbers gave us such a decreasing data, but it's clear from previous PMI and PCE data that the fairy tale afternoon is over. Essentially, anything higher than the current data is a green light for a larger interest rate hike, while it's technically a disaster. The third piece of data is the monthly core CPI, which used to be the Fed's favorite measure. It's not as much of a favorite anymore because it has been increasing for the third month in a row. At the time when it began to decrease, the Fed itself said how original it was. So it seems that the increase is also original, right? Meaning that Powell may be sweating more and more, and it increasingly appears that much more rate needs to be raised if this data turns out to be hotter than necessary. This means that anything above 0.4% is roughly 4 tons of fuel to an already burning fire. The data could decline, but in this case, we would be going against all the previous data that everyone knows it's artificial. So the market reaction will ignore it even if the Fed reassures itself with it. A higher than previous data is fuel for the DXY as well, while a weaker one is, well, also, but it's just less. But America does not stop, smashes forward, well, but downhill ahead of everyone, and it wants to continue this with Wednesday's data. Several pieces of data will be critically important, such as core PPI, core retail sales, Empire State Manufacturing Index, PPI, retail sales, and crude oil inventories. In this video, we will look at the PPI, but for those interested about how the others impact the economy or the stock market, visit the website where you can find the pro level. There, we not only explain these data, but also draw the proper conclusion if the results are significant. The US core PPI, so Producer Price Index, is a measure of the average changes in prices that domestic producers receive of their goods and services, which can be highly volatile. This is why it is often misleading as to what we should be looking at, core or non-core. Well, it depends on why we want to know the data. The core PPI is an important economic indicator because it gives insight into the inflationary pressures within the US economy. If the core PPI increases, it could indicate that producers are facing higher costs, which may lead to higher prices for consumers. This could, in turn, lead to inflation, which is a concern for the Federal Reserve and for investors. So the recent sweat drops on Powell's forehead increased because the CPI came out and he didn't like it. Then PCE, and there was one more drop on his forehead. And I don't even have to mention that the previous 0.5% data, which jumped massively from January's 0.1%, didn't calm him down at all. For investors, the core PPI can provide an indication of future monetary policy actions by the Federal Reserve by looking at the increase or decrease in sweat drops. If the core PPI rises more than expected, the Federal Reserve may choose to raise interest rates in order to control inflation. This could impact the performance of several asset classes, such as stocks and bonds, as we have talked about a lot before. So if data continues to rise, it will not help stocks or commodities, but it will definitely help the DXY. And here comes the big brother of the core PPI, which is the PPI, a real heavyweight data. The difference between the two is that this one already includes sales of cars and fuel. So the swing on the data chart are much bigger in all directions, making it harder for the Fed to draw conclusions about the real situation. However, it reflects a very similar picture to the previous core PPI. The February data was 0.7%, which also jumped up with huge leap. All conclusions drawn are the same as before, so I don't repeat myself. However, let's keep an eye on this data and its timing, as there may be serious reactions even among traders. And now, Thursday afternoon tea time. We could say it in an English way. Well, we could, but then this tea would be on the deck of the Titanic when we are crashing into the iceberg at full speed. So it's going to be a shaky tea, especially since we have data coming in like Australian employment, US unemployment, US housing starts, the horror of the European Central Bank. So for now, we'll focusing on US employment data and the ECB and some more. So we already know this. If unemployment increases while inflation is high, baby carriages become more expensive, people become more impatient and start eating up each other. Meanwhile, the Fed rubs its hand because the economy is slowing down, which makes it easier to fight the sword of inflation. This is why, of course, the Fed switches to the dark side, as everyone will lose with this. We'll lose jobs, colleagues, food, family, everything. Now, I'm not defending the Fed, as obviously we can criticize them, but there is one thing here, somewhat understandably, many of us forget in the middle of a cannibalism. In reality, the Fed doesn't have many tools against inflation, but what little they have can be effective and drastic at the same time. So they don't have many choices other than causing a little harm or a lot of harm. But what happens if they don't do anything? Well, in this situation, they let inflation go, which turns into hyperinflation, and everyone still ends up eating each other and their neighbors as well. The difference between the two cannibalistic periods is that while the first version lasts for a limited time only, the second lasts until the last standing person. We've seen this in, for example, Hungary, as other places, and it wasn't a pretty sight. So it's an unpleasant situation, and of course, we can discuss how we got here. Many people can be blamed, often rightfully so, like the rich, as they stuff their pockets with our money. But let's not forget that the rich also have to sell something to the poor in order to make money out of the poor. So the greed of consumption also plays a huge role in this. Therefore, the numbers of American unemployment claims can help in the long term. So because it also helps Fed, and people might not eat each other, at least that much. And so the unemployment data will increase, I'm sure of it. Perhaps not this week, perhaps not next week, but it will. The increase itself can help weaken the DXY, as it signals the slowing economy. Of course, if this were the only data that affects the US dollar, but it's not. The only thing we are watching for this is the increase. I mentioned earlier how much power is sweating right now. Well, until this data increases, it will only continue to make him sweat, and there won't be any counter pressure on the US dollar. So we observe, but we know what conclusions to draw if it changes. And now, US housing starts is an important indicator for calculating with the amount of new houses being built. We can also draw the conclusion from this data as to how close we are to a collapse. However, it is not a straightforward proportional relationship. At the beginning, or before a recession, we'll see a decrease in purchasing cheaper goods, but the wealthy can of course take advantage of the current situation to invest in cheaper houses. Cheaper because agencies try to get rid of the current houses, therefore they are reducing prices. So if fewer houses are being built, it means that even the wealthy are beginning to run out of the money. This is when bigger trouble usually begins. So the data itself is an indicator of when the next episode of Walking Dead will be. Currently, we are not close to zero with new house constructions, so there is still money that can be squeezed out of the wealthy. And it doesn't necessarily have to go down to zero. It depends on how quickly we settle the inflation issue. However, if the Fed is unsuccessful for a long time, a stagflation environment sets in, and that's already a problem. Currently, the data has fallen 44% since last April's high. If it stagnates below 50%, that's a good sign because it preserves the foundation of stable construction numbers. But if it falls below that, the slowdown may accelerate, and in that case, we can expect the real estate market to, collapse. So we need to go below 0.9 million for that. And the EU main refinancing rate, so in other words, MRR, is the interest rate at which the European Central Bank, so ECB, lends money to commercial banks in the Eurozone. This is the ECB's most important interest rate and serves as a benchmark for other interest rates in the Eurozone. Therefore, it also affects how much interest you will pay on your loans in the Union. Spoiler alert, it will be very high. So MRR is important for investors because it affects the interest rates that commercial banks charge us for loans. Just to be clear, if the MRR is low, then banks can borrow more money from the ECB at a lower cost, which means they can offer us lower interest rates. This can lead to an increased borrowing and spending, which is very good for the economy. However, this is not the case right now, so we can guess how the economy will react. Well, badly. Currently, the MRR is high, so the interest rates on the loans are also high for us. But as investors and traders, we also pay close attention to the MRR because its changes can affect the value of the euro and stocks. I mean, European stocks. For example, if the ECB raises the MRR, it can lead to a stronger euro and lower stock prices as we expect slower economic growth. On the other hand, if the ECB lowers the MRR, it can lead to weaker euro and higher stock prices. This is just a small part of a data bunch that can affect the price of the euro, stocks, and other market assets. In addition, there are many other complexities we often talk about. So we don't need to go into too much details about the outcome of its impact. Perhaps it's worth discussing how traders and investors respond to it and in what way and pace. If you're interested, let me know and I'll explain a little bit deeper. But it's better to do on the Discord server anyway. For now, let's focus on what the ECB should do, which is to raise the MRR. And they need to do it by a lot and quickly because they could get into a similar spiral than the Fed. Therefore, we still expect interest rate hikes and the effects described above. And so I told you that Friday will be very bad last week. Well, it actually was. We closed the week again with 4 important data points. The EU's final CPI and core CPI data are coming, which are important for reasons that need no mention. And there are 2 American data worth paying attention. One is the consumer sentiment, which will reveal the spending mood, and the other is inflation expectation. So we will take the mood from this with actually a good reason. The US preliminary University of Michigan Consumer Sentiment Index, is also known as UOM Consumer Sentiment, is a monthly economic indicator that measures the level of consumer confidence in the American economy. We can generally describe it as decreasing confidence, but there has been some increase in the past 4 months. Well, thanks to the end of the year holidays and the romantic February. However, now there is another festive menu called inflation and the month of bleeding banks. This data provides insight into consumer spending. Of course, as an investor, this is an important information because in the case of a decrease, there can be a fundamentally less inflow of money into the market, while in the case of an increase, people may feel relatively safe towards investment. So crypto lovers, you need to watch out. So if the increase of the past months is interrupted due to the current inflationary prospect, it is just another nail in the coffin as fear is proven and large quantities of Wall Street put options contracts may follow. And so here we are with actually crypto banks are off the table. Other banks are going off the table either, heavily sweating Jeremy. And the question is, will the bubble pop? The stock market is down and the US 30 fell a lot in the last 4 trading days. Breaking this wedge to the downside is never a good sign, and the next major level is far away yet at 29,624. The SPY also freed out and broke a line that could have a serious impact towards 364. Meanwhile, Nasdaq is holding up just a little better, but in case the zone fails to hold, short power, or I should say short Powell, will kick in. But hey, where is the money? When stocks are down, almost all of them, most of the commodities are down. There are 2 things. One is the bonds, and second is our good old friend, the gold, after a golden cross and a pretty nice looking retest. So if you're interested in that, you should visiting the Discord definitely. Even the DXY managed to slip under the 200 EMA, but the 50 EMA catches for now. That's why this week macro will be extremely important. Wall Street sell-offs mode is on, and if DXY will rise, all hell loose. But this is a good news for forex traders as stable movements are expected. Well, not a surprise that right after the golden cross, the total market cap on the crypto market got crushed and about to form a death cross. Perfect invalidation, and the bank bleeding machine will hammer the market, at least for a while. No need to mention how bad news is for the Bitcoin. which is not far away from the zone above 18,000. The momentum is there, and if the DXY helps, it will be a short story technically. I hope the information was, useful for you. Remember, at the pro level, we analyze every major macro data and draw the appropriate conclusion when they arrive. If you want to join, visit our website, link in the description. In the meantime, I would love to hear your thoughts and opinions in the comment section. If you want to stay informed about next week's data and other useful information, subscribe and turn on all notifications. And if you enjoyed the video, give us a thumbs up so it can reach more people. See you in the next video.